Hi, and welcome to the Day Trading for Beginners podcast. This is season 3, episode 2. And in this episode, we're talking about market structure. So my name is Tyler Stokes from StokesTrades.com. I'm on a journey to become a full-time day trader. And here we want to talk about market structure. Now, this is something I probably should have covered in season 1 when we were talking all about technical analysis. It's very much a beginner type topic. However, I didn't get around to it until now in season 3. And I'm kind of glad I did in terms of this podcast, because over the last, 6 months of me studying a strategy, actually looking at charts, I've come to actually personally understand market structure a lot better. And I think that this podcast is going to be more beneficial now, releasing it now, as opposed to when I was sort of just learning it myself. So as always, below this video, you can find some resources. If you are a first-time listener, you can go and download the 6-month blueprint. You can go to StokesTrades.com/blueprint, or you can find a link in the show notes. And that's going to help you get on the right path to starting your day trading journey, as well as our community on School. You can find a link to that below this video. Now, here we are talking market structure, podcast form. I'm hoping that this is going to be useful, but do check out the links below, because I am eventually going to have a YouTube video about this where we are going to actually look at some charts, and that's going to be, much more beneficial as well. And as with all these types of podcasts, this is just an introduction. Certainly, you will want to find other resources for market structure. Don't take this one podcast as the only resource you need to sort of master this. Many people explain market structure a little bit differently, specifically the various time frames that you're looking at in market structure. So it's always good to get a bunch of touches on this from various people to fully sort of understand. But here, what we want to do, talk about market structure, sort of more of a beginner type of discussion, and talk about just a few key terms with market structure, and talk more about the high time frame market structure, because that's what I personally have been looking at in terms of my trading over the last sort of 6 months. I'm doing more of a momentum type of trading strategy, because day trading for me at the moment is not working with my personal schedule, but momentum trading is working much better, because I don't need to look and trade every single day. I just can't be doing that right now. So personally, high time frame market structure is something I've been looking at. So weekly charts and more of a monthly charts. But depending on what trading strategy you look at, you might be looking at market structure on the hourly chart, and then things are going to be just a little bit different. So just keep in mind, when you're studying market structure, explanations are certainly going to differ based on the time frame that you are trading your securities or whatever you are trading. Now, I'm recording this podcast March 1st, so it's actually a good time to think about market structure, because we have been in a bullish market, and recently in the last week or so, the last week of February, there's been quite a bit of a sell-off. But many people are going to say, the bear market's here. We're going to be finding even lower lows, or Bitcoin is no longer going to rise the rest of the year. It's always good to take a step back, look at the high time frame support, and kind of see, is the market structure for sort of a monthly time frame still intact? Are you still making higher highs and higher lows? So it'll be interesting to see, in the coming weeks, if, a lot of this sell-off is just, a liquidity grab, a chance for the market makers to kind of push prices down because they've been overextended, and then still maintain this healthy bullish market structure. So hopefully at the end of the podcast, you'll be able to go into TradingView, look at some charts, and sort of understand that and kind of compare it with what's going on in the real market right now in terms of, some sell-offs, but maybe, it's just a temporary push down and the market structure is still positive. So basically, if you are new to trading, or perhaps you've been, following along and you've actually been doing some paper trading and you've been looking at some charts, when you were starting out, I think every trader, when they start out, they look at these price charts, they look at candlestick charts, and they're sort of wondering, how can you make sense of this all? Well, understanding market structure can help you get a clear story of what is going on with that particular stock or that security. You can spot trends, you can potentially predict reversals, and you can trade with much more confidence when you understand market structure. So in this podcast, what we want to do is talk about it for the beginner and just learn some basics of things like a BOS, a break of structure. So what that means, talk about a change of character. That's another main term. And then just talk about the general patterns of market structure. So higher highs and higher lows. And again, below the podcast, we're going to have a link eventually where you can see a YouTube video of this. It's going to help actually seeing some visuals as well. So we're going to have some examples in this podcast. So if you're listening, you can kind of understand. They're going to be very simple stock prices. Just understand that they are just for example purposes. Stocks move much differently up and down and so on, but we're going to use some round numbers just to make it more easy to understand through audio. So basically market structure, well, what is it? Well, it's the shape prices carve out on a chart over time. So it's how traders figure out if the market's trending up, so higher highs, higher lows, or trending down, lower highs and lower lows, or just, drifting sideways. That's consolidation. So you can think of it, if you want, like a river. This was an analogy from Grok that I got. Up close, you can see little waves, and that's kind of like short-term moves. But if you step back, you can see the whole flow, and that's like the bigger picture trends. So the catch, like I mentioned, is that time scales that you're looking at will matter a lot. So if you're looking at an hourly, a daily chart, or a weekly chart, it certainly does change the story about the various structure of that particular market on that time frame. So an hourly chart might show that a stock is climbing fast with each peak and dip higher than the last, so making higher highs and higher lows. That's an uptrend on a short time frame. But when you zoom out to a weekly chart, you'll see that those wiggles might sort of flatten out into nothing and reveal a bigger, slower move that you may have missed. And it might be, trending actually down. So neither view is necessarily wrong. They're just through a different lens. So it's important to understand that short-term traders, they will chase these hourly waves. Long-term traders are more concerned with, the weekly tides, if you want to stick to that river analogy. So you're going to have to pick one that suits your trading strategy. I think based on what I've learned over the last year or so, it's always good to just generally know the market structure in terms of whatever strategy you're using. I'm sure there are day trading strategies that focus on short-term timeframes that don't really necessarily care if the general market or the general market structure of the particular security is bullish or bearish. I'm sure that's the case, but I think it's always good to just generally be able to look at the market, look at the indexes, and just understand if it is bullish, if it's in an uptrend, or if it's bearish and we're in a downtrend. And market structure certainly can tell you that. So the building blocks of this is something you've probably heard many times before: higher highs and lower lows. So these patterns are really the heartbeat of market structure. They tell you who's winning. Are the buyers winning or are the sellers winning? So what we're going to do is just, again, use some clean numbers to keep it simple. Again, real charts are much more wild, but you'll get the gist of it through these examples. If you want to just think of this as sort of a sketch, not a photo in terms of what we're going to talk about. So higher highs and higher lows, that is an uptrend. So when the price of a stock, for example, hits a new peak, so that's a high, but then it dips and stays above the last low, that's a higher low. And then it climbs up again. So example, say we've got a stock that rises to $40, retraces back to 38, that's the low, rises now to 42, we have a higher high. We're in an uptrend, and then it might retrace back to 39, which is a higher low. So 39 is higher than 38 and 42 is higher than 40. We're going up in a zigzag. We're going up. That's an uptrend, higher highs and higher lows. So it's like, stairs going up. The buyers are sort of in charge here. Now, in terms of strategy, we're not going to talk too much about strategy, but sometimes people buy when there is that pullback. So you reach a high of 42. If it pulls back to what is shown to be confluence around a support zone at 38, that might be an opportunity where people buy. And then the stock rises back to 42. So there are strategies involved with market structure in general. Lower highs and lower lows. So now we're talking a downtrend. So price drops to a new bottom. That's the low. bounces but stays below the last high, we've got a lower high. Then it falls again. So example, say we've got $50 as the high and we drop down to 48, which is a low, and then we rise back up, but we only get to 49. So it's a high, but it's lower than 50. We've got a lower high, and then we drop down to maybe 46. We've got a lower low. So we got a staircase going down. The sellers are sort of in charge. So these are the general structure, very basic of market structure. And this goes on until something disrupts them. Now, if we want to talk a little bit more technical about what's going on here, we've got two sort of definitions that we want to cover in this podcast. One is called a break of structure. And you're going to learn this and be aware of this when you dive into more detailed analysis of market structure, and then a change of character as well. So a BOS is break of structure. You can think of this as like the trend's green light. So a break of structure is when price smashes past a key level, proving that the trend is still kicking. So in an uptrend, another example, price makes a higher high, pulls back, and then breaks above that high. That is a break of structure. So if we've got that example we were talking about, we've got a $50 stock price, it dips back to 48, and then it breaks to 51. As it breaks 50 there and reaches 51, that is a break of structure. Buyers are flexing. The trend is still alive. In a downtrend, as price hits a lower low, bounces, and then breaks below that low, that is another break of structure to the downside. So if you've got $50, stock drops to 48, then stock rises back to 49 and turns around and drops to 47. We've got a break of structure, drop below the low of 48, a break of structure to the downside. That is the definition of that. Here, the sellers are winning. So a break of structure, a BOS, it's a signal to stick with the trend. It's confirming that things are still moving in that direction. Now, the other thing that we have here is called a change of character. And that's when, it could be a warning sign that the trend might be reversing. So a change of character is when the price breaks a key level against the trend. So that could be a hint that we could be flipping the trend here. So this might be, when the market whispers heads up, things might be changing, and it's good time to be cautious no matter what time frame you are looking at. So again, in an uptrend, if price has been climbing, but then drops below a recent high and drops below that recent high, we might be changing the character of the trend. So examples here, we've got $50, and then as the high, we retrace a bit to 48, and then we hit 49, a lower high. Then we come down to 47. We have a change of character there. We've got a lower high there. So basically, we've got a lower low, or excuse me, a higher low, and we come up to a lower high there, and we break down. We could be starting to lose that structure. So 48 was the higher low, and as we pull down, we break past that to 47. So we are no longer in that higher high, higher low structure. We've broken it because we've dropped below that higher low to 47. Now in a downtrend, it's when, the change of character might be to the upside. So we've got $50. We move up to 52. That was the previous lower high. And then we break up to 54. So we've broken the lower high, we've broken the lower high, lower low structure, and we're breaking back up and changing the structure from a downtrend to an uptrend. So again, a visual of this is probably going to be beneficial for you, but just understand that a change of character, it's a heads up to rethink the trade. There might be a shift in the whole story. It's when you're no longer making those perfect break of structures, peaks from higher highs to higher low. You've got something that's broken that basic framework of market structure, and it could be indicating that the trend is going to reverse. Not always, but it could be a sign to be cautious. So if we put it all together, again, just talking about some of these examples here, again, uptrend, we've got higher highs and a higher low. So we've got 50 to 48, up to 52, back to 49. We're making higher highs. When it breaks to 52 there, breaks that 50 original peak, we've got a break of structure. The buyers keep pushing up. This is a time where people jump in. We've got a shift now. So example, we hit $55. Now we dip to 53, which is a higher low. Then we go up to 54. So we don't make a new higher high, we make a lower high. Then as the security crashes down to 52, we have a change of character. We've no longer maintaining that low of 53. We could be changing character. The uptrend, it could be shaky. It might be time to exit. Things might be going in the other direction. So those are the general, very basic, easy visuals of market structure. So why does this matter for beginners? Well, I think if you master these basics, again, if you jump to charts, go to TradingView, you can get a free trial with TradingView. It's the charting software that I use. You can actually look at these charts and you can start to try and visualize this market structure, and being able to master this and being able to see market structure, it's going to give you an idea of the direction without sort of guessing. You can focus on the charts instead of the news narratives. There might be news narratives for whatever reason, but if the charts don't sort of go along with those narratives, then, they could be, could be just a distraction. It could be all noise and no signal. So you can focus on the charts when you understand market structure, and you can trust your strategy if you understand market structure. And then, whatever strategy you're using, you can use some of your entry points or exit points based on market structure. That could be part of your overall strategy. So what I would do is, start small. You can get a free tool like TradingView. You can pick a stock like Apple or Tesla, anything, and start marking the higher highs and the higher lows on various time frames, and see if you can kind of match and indicate when there's been a break of structure or there's been a change of character. And soon, the chaos on the charts, when you look at it as a beginner, will start to turn into more of a story that you can follow. Now, final thoughts here. Market structure, it isn't a mystery. It's basically price showing you who's boss, the buyers or the sellers. So if you can identify break of structures, you can ride the trends. If you can identify change of characters, you might be able to spot some reversals and just understand the higher highs, lower lows to keep track of the direction that the security is going in. Keep it simple. Practice, just following a stock for a period of time. I found that, I've been watching certain stocks over the last 6 months, and I've got a better picture of how important market structure is. And sometimes, as someone who might be studying a day trading strategy, you might be only looking at very low time frames. So some of this might feel like it doesn't matter as much, but if you can kind of step back and get a general sense of the broader market structure on a weekly or a monthly time frame, you can kind of see the general direction that the market is going. And I think that's going to be beneficial for any type of strategy that you are using. Also, just do keep in mind, we mentioned quite a few times that the time frames that you're looking at and trading with is going to dictate whether the market structure matters for your strategy. So if you are doing a trading strategy that I'm currently doing, a momentum type of trading, then the day-to-day fluctuations don't really matter as much. The market structure on an hourly chart isn't going to dictate the trades that I might be making. However, if you're day trading and using much lower time frames, then that market structure certainly is going to matter. It's still the same definitions, the same theory of how everything works, but you're looking at a lower time frame. That market structure matters much more than the weekly and the monthly time frames as well. So I hope that you found this useful. The best thing to do, and the main thing I want to get across with this podcast, is that market structure is super important to understand. I would recommend that you learn this and you can understand, you can look at a chart and understand the story. And I think it's going to be beneficial for any type of strategy that you do end up using. So thanks so much for listening. Below, again, in the show notes, we've got resources that you can take advantage of. You can join our community on School, which is free. And eventually we'll have a video episode that will demonstrate this with some visuals that will be beneficial for you as well, I believe. So thanks so much for listening, and we will talk in the next episode.